right, here we go. It is the last trading day of the Biden administration, January 17th. I am Benjamin Bry. We have our energy expert, Bob Morris, who's loving 2025 versus 2024, and special guest, our buddy from Florida, Craig Shapiro of the Bear Traps Report. All right, let's get it going. We'll start with Bob. Bob wrote a nice note last night about his favorite Canadian energy company, C&Q. Tell us what you got on that, Bob.
Yeah, thanks, Ben. So it's interesting because when Trump was elected, he said he was going to put 25% tariffs on all imports from Mexico and Canada, including crude oil. And the market sort of shrugged it off for the most part and said, well, he doesn't want to do anything that's going to push up oil prices, and there'll be a carve out for Canadian crude oil production probably, and we're not going to worry about it. And so C&Q continued to do well. In fact, on Monday, initially, it touched a 1 month high almost, but then it's come off since then. And what happened was the Alberta Premier, Danielle Smith, went down to Mar-a-Lago last weekend and met with Trump. And she came back and said, look, I wouldn't bet on there being a carve out for crude oil exports to the U.S. as far as the tariffs are concerned. And so then everybody said, well, wait a minute. You mean he might really do this? He might really put a 25% tariff on crude exports from Canada to the U.S.? And suddenly that became a concern when prior to last weekend, nobody really thought it was a concern. In fact, C&Q last Thursday put out their 2025 budget and guidance, did a conference call, and didn't even talk about tariffs. And during the Q&A, nobody asked about the tariffs. So it wasn't even in anybody's mind or thought process as of last Thursday. Now, all of a sudden, week to date, C&Q's underperformed all the large cap E&Ps by 10% because people all of a sudden are concerned that, wow, if this happens, this is not good for C&Q. C&Q is the largest crude oil producer in Canada, and nearly all their exports go to the U.S. Now, the problem is that if Trump puts a 25% tariff on crude oil exports to the U.S., the importers and the refiners who buy that crude in the U.S. pay that tariff. And what that means is that's going to push up prices at the pump. And that has to be absorbed by somebody, and it's going to be absorbed by the consumer. So that goes counter to Trump's objective here early in his term of trying to bring inflation down. That's not going to help him at all. And so, we'll see what happens. People believe that, threatening to put 25% tariff on Canadian crude oil imports was posturing, and maybe it is, but we know how Trump operates. He postures pretty hard. And so, we'll see what happens. He said he was going to do it day one. So you could see Monday him come out and say, yeah, we're going to put 25% tariffs on everything. And then they sit down to the negotiating table and see what happens. And, all of a sudden, all the Canadian premiers and officials are in a panic, and all the big energy producers have formed a coalition to try and go in there and negotiate and prevent that from happening. In the meantime, it would be a big impact on the Canadian producers because it's going to impact the price of crude that they send down here. That differential between WCS and WTI has been running around $12, $13 a barrel. That could widen out by another $5 to $10 a barrel if this happens. And so when you look across the board, C&Q is by far the most sensitive to changes in crude oil prices. I mean, that's good on the way up. It's bad on the way down, but it's because they have such strong margins. So that, that dollar per barrel has a big impact on the bottom line for C&Q. We'll see how this all plays out. But if this continues to be an overhang, and the stock's sort of settling out here today, it's not underperforming today, but this is a stock with our view on oil prices holding up here, $70 to $80 a barrel. We'd be aggressive buyers of the name if it dipped back below $30 a barrel. $30 a share. In December, around December 19th, we came out and pounded the table when it dipped below 30 and said, look, we'd aggressively buy this name. It's, as you mentioned, our top oil-focused E&P. And so right now, the dividend yield is 5%. They've raised the dividend every year for the past 25 years. They're definitely going to raise it again this year. They may raise it here when they report fourth quarter results at the end of February. They typically do raise it then, but last year they raised it twice, and they last raised it at the end of October. So whether they raise it here again at the end of February, I don't know. But at some point, they will raise that dividend this year. Like I said, it's already at 5% yield. So net, it could be choppy depending on how Trump postures here and the negotiations and such. At the end of the day, I really don't believe you're going to see a big tariff on Canadian crude imports. Maybe initially there'd be a little bit, but it's bad for inflation. And so any dip below $30 per share in C&Q, we'd be aggressive buyers. Look, if he does put on a 25% tariff, if that does happen, technically this thing could dip down to as low as 28. But that in that range, 28 to 30, I'd be, as a long-term investor, aggressive with a buy in C&Q here.
Right. So it was at 48, and then this kind of comes out, and we have the absolute worst thing that can happen to an investor is I'm long energy. Energy's been on its ass, finally gets going. And then I just like, oh, Trump was like screwing me out of like my move. So $4, and you think like 28.30 is kind of where the 25% tariff level is. So it's pricing in roughly 10 to 12% tariffs. Would you think that's fair right now?
Yeah. At this point, yeah. And, and that's US dollars. You said 48. I don't know if you were talking Canadian dollars when you said that, but yeah.
I'm just looking at the chart. I think it's in Canadian dollars. Sorry.
Yeah. So we're talking US dollars here.
Okay.
But yeah,
Okay.
it's probably pricing in right now around 10% tariff.
So in the US, where is this trading at? What's the current price?
It's trading at $30.60, I think.
Okay, so this actually now it's pricing in more than that, right? So if you're saying below 30, it could get to 27, 28. Now we're pricing in much higher percentage of tariffs than I was thinking looking at the Canadian one.
My view is if you've got 25% tariffs all of a sudden, this thing could trade down. Technical support is 27.50. It could trade down to 28, 27.50. And on my model here, every dollar per barrel change in the oil price forecast is about 2.9% on the annual cash flow estimates for C&Q. So it's pretty sensitive to any move in the oil price, whether it's because of tariffs or because something else that happens around the world.
Right. And I know you sometimes like to sell premium on things would you sell some puts like the 25s or 26s? Because I'm sure vol has kind of popped up because there's this binary uncertainty of what policy will be. Is that something you'd be interested in doing right here today?
Not yet. If it pulls back here, maybe I'll do some of that, but I'm just waiting to see how things play out through Monday. But no, I'm not writing puts yet, just because this could be very binary depending on what Trump says on Monday.
Right. Okay. And then one more thing on energy, and then we'll open it up with Craig on the broader discussion of energy and tariffs is, when you look at this move to start the year, what do you think the biggest drivers are that have pushed this forward as we kind of went from no one talking about oil and being just kind of like forgotten to now it's like top of mind, and now we're on $80, WTI, or maybe it's a little bit 78 today, but like, and Brent's back up there. Like, what do you think has driven this, and is it sustainable for the year?
Yeah. So, toward the end of last year, people were saying, well, ourselves included, what is the bull case? It's hard to make a bull case with demand softening in China, with OPEC, posturing to begin to put some of their curtailed barrels back in the market at the end of March. And what's happened in the meantime is U.S. crude oil inventories have come down quite a bit. So all of a sudden, supply seems to be tightening a bit here. And at the same time, there's a little bit of optimism that the stimulus in China might begin to work. And so it's really the inventory issue here in the U.S. is pushing the oil price up. And I think there's some short covering too, just on that happening and everybody having been sort of bearish, that quick turnaround has prompted a lot of short covering in the crude oil markets. But I think that's the big driver. Initially, people kind of got bearish too on the fact that when Trump was elected, he had this mantra, and still does, of drill, baby, drill. But and we've talked about this before, that there really isn't anything you can do incentive-wise to get all these oil and gas producers to go out and suddenly start drilling a lot more oil wells this year. That's just not going to happen near term. They're going to continue to maintain their discipline and try and return capital to shareholders, which finally has been working in helping gain some credibility for their shares. So I think, too, people are realizing that, well, yeah, drill, baby, drill sounds good, but that's not going to bring the oil price down.
And the SPR has actually started to creep back up as well. Do you think that there's any meaningful adds to that? I mean, I know that with us being exporters, we don't really need to be back at the level we are. So that 300 million that Biden took out, to save the market and the economy in 22, it doesn't have to be full, but do you think you could add 50, 100 million barrels to that in the Trump, or do you think that they'll leave it where it is?
I think they'll slowly start to refill it. I don't know if 100 million barrels is something they'll get to anytime soon, but they don't want to fill it at a pace that's going to push the oil price up. But they'll want to slowly start to begin to refill that. And that's what
Right.
we've been
Okay.
seeing here recently.
All
And the
right.
other thing
So,
I didn't mention was there's these sanctions on Russia too, that another round of sanctions kicked in the last week. And that added a little bit further bullishness to the market. And China started buying crude oil elsewhere to stockpile if they're not going to be able to buy from Russia with these additional sanctions. So that was another factor on top of the U.S. crude oil inventories dropping.
right, and you've seen tanker rates really kind of rip recently. The VLCCs and even the Aframax is starting to go up some. And I think in your note, one thing that I'd point out for listeners here is you noted that new pipeline will allow Canada to sell, what is it, 15, 20% Q, I guess, yeah, of their oil to Asia, basically via boat. And so with all this, it's Trump is, America first is his thing, right? And so it seems like they're trying to shake up the trade of the world, and energy being one of the bigger international trades. It makes sense that tankers are a natural play on this. And without getting too much into tankers, I did a lot of work on this a couple of years back. Is there's a supply and like there's not a lot of supply coming online in those, so that there's something to be looking forward in those. But Craig, let's pop it to
Just
you.
one other thing I wanted to mention, Ben, just real quick too. I should have mentioned too. It's just this weather. The weather has had an impact on oil too. Obviously, it's had a huge impact on natural gas, but the weather, people burn heating oil too. We've repeatedly mentioned that. I've seen around here in New Jersey more heating oil trucks making deliveries in the past 2 weeks because the cold weather drives up demand for heating oil, which is a byproduct of crude. So we're sort of a third variable that's been bullish here for crude oil in the past few weeks.
Right. Okay, so yeah, I mean, it's been a nice start to the year. But now, Craig, like, riffing off this, what do you think the impact of oil and tariffs are, on the markets broadly going forward? I mean, you
Yeah.
see this as, like, the market's rallying today, and we're kind of complacent. We came off some, but we're still sitting at very high levels. So what do you think, as we go into the next trading day, being the tariff man's back in action?
Yeah. Yeah. Look, I mean, if you think about just the cadence of the last 9 months or so about, certainty and uncertainty, right, regarding the election, in the summer, when Trump beat Biden at the debate and kind of forced him out, we had all these strong Trump trades, and there was certainty coming back that he was going to win and beat Biden. Then Harris comes in and she generates a ton of momentum, and all of a sudden the election looks like it's going to be a lot closer. And what happened in that July, August period is that the uncertainty of the outcome about the election really started to impact the economy. So much so that, remember that payroll report that came out in July was awful, in early August, and there was calls for big rate cuts, and that negative economic momentum continued and really, forced the Fed into that 50 basis point rate cut, in my view. I mean, it was that uncertainty around the election, I think, that kind of scared them. And subsequent to that, what you had really is an economy that really didn't need that level of stimulus. And once Trump wins with the Republican sweep, what you have is a certainty resumption, right? You basically have small business confidence has been roofing. All the sentiment indicators are moving higher again. And so there's this general sigh of relief that Democrats won't be in power to exit the year. Tax cuts are coming back, and all the good parts of the Trump trade play out largely in November and December. And really, we're seeing some of that into the data now in January. The issue is that Trump's policies are very uncertain, right? We don't know how serious he's going to be on tariffs. We don't know how serious he's going to be on sanctions, on oil sanctions for Russia, for Iran, on tariffs for China, on tariffs for Canada and Mexico, on tariffs for Europe, on tariffs for Japan. I mean, so, and there's this view, I think, that, Trump uses the markets as a scorecard. And so anytime there's a bit of market check back, that means he's going to panic and he's going to not go ahead and deliver on some of these negative market dynamics. And so, look, I would say the difference this time around versus when he was put in power 8 years ago is the leaks are not there, right? It's been pretty tight-lipped. We don't really know what he's going to do until he starts doing it on Monday. And I think that's by design. I think that, he largely views the first couple of years, or certainly the first year of his first term, as a failure, in that it was bogged down by infighting, and he, really couldn't get his agenda going. And so this time around, I think he's going to be pretty, focused on the things that he campaigned on, which is, immigration reform, which is tariffs, which is the government deficit. And so, look, I think with the markets at the highs, Trump has some ability here to deliver on some of that rhetoric, that hawkish rhetoric, and blame the old guys, right? Blame Biden, blame Yellen, blame Powell for, orchestrating this country, which, he has said is, in disarray, right? And so I sense that he's going to be very hawkish on tariffs when he comes out, next week. Maybe it's going to be blustering ultimately end, but this is the setup for the negotiations for him. So I think we are moving now back into a period of uncertainty about this. And so now economic actors will react accordingly, or probably already have. And so maybe some of the pre-buying into year end starts to dissipate. Yields have been moving higher. And I'm concerned that we're going to see a little bit of a hiccup here in economic growth momentum in the, certainly we're seeing it already overseas. And I think that's going to start backing up into the US. And I would expect the data, probably not for January, but maybe for February and into the end of the first quarter and for the second quarter to start showing some of that disappointment. So, but hard to get ahead of the guy. We gotta wait and see.
It is interesting how much, Bob knows C&Q extremely well, and we're like, next week is this, and people are just, now like, what if there's been a very laissez-faire attitude towards all these policies that, he's not going to do that. He's not going to do that. And so what I think personally, and I've said this to a lot of guys on this show, as Craig have privately said this to you, is that the tariffs, like, what does Trump love? He loves America. He's America first guy, and he loves lower rates. He's a lower rates guy. So if we look at the situation now where Bob's fairly bullish, more like as in the last year, he's as bullish as I've heard about him talk about energy and oil. And we all know energy is the primary money. So when that goes up, it's the short-term driver of inflation. So now we're on day 17 of January and oil prices are up 10, 12%. Well, you have to think the CPI is going to come in a little hotter in February. And by the way, it was hot this week. Like, it just wasn't hot enough. So there was a positioning unwind, I think, that all this was. But 3.2% inflation is well above the level anybody is like, oh, that's great. I mean, the purchasing power erosion at that level is enormous over time. So we get this guy to come in. Either they come in and they're like lax, like what Bob's saying the assumption was, and they're like, oh, it's going to be gradual, or it's going to be 5% or whatever. Or they come in hard, as you're saying, makes the market take them seriously, and then that cracks inflation, and then basically strong dollar and lets them lower rates domestically, which is good for the USA ultimately, but it's, some things will get hit on that. What do you think about that?
Yeah, look, in my view, in order to really bring inflation down, we need an asset price correction, right? I mean, so we need to hit the wealth effect a bit. It's not a popular thing to say or do, but it's the reality. But there's still too much money. There's too much wealth, and the lower rung of the K-shaped economy is increasingly getting squeezed by higher inflation and higher rates. And, I was just looking at some charts comparing things back to 2022 when we had the inflation spike and the Fed reacting and oil then ripped. 10-year rates were sub 3% in the first quarter of 2022. Mortgage rates were 4%. I mean, they're over 7% now. Credit card rates were 14, 15% in the first quarter of 22. They're 24, 25% now. So the low-end consumer is getting destroyed, is getting crushed by these higher rates and this resumption of inflationary momentum. And so the way to bring it back is through an asset price correction, which means we need kind of tighter for longer policy here. We need, Trump needs to go hard on this tariff idea in order to bring back manufacturing jobs and, to America. And so the question will be, how much will he be able to tolerate that kind of asset price correction? I mean, this is the same guy that was signing pictures of the S&P 500 on Fridays in his first term when it was making new highs. So he likes to use the stock market as a scorecard. And so, look, if he gets some of these things, it makes sense to me that he would try to get some of these things done early in the term when he could blame the old team for an asset price correction. The longer we go without an asset price correction, it becomes his problem. And so I think to believe that where he's going to run the economy and run the markets hot for the next 4 years, I think is not likely, and it is naive. So sooner rather than later, which argues for more hawkish rhetoric on trade, on sanctions than not. So look, even this, I think the Russian, sanctions on oil, I think are going to be followed by sanctions on Iranian oil, right? It's like an escalate to de-escalate policy and try to drive. And you heard Bassett yesterday on the Hill he said, make Iran poor again. That's the Secretary of the Treasury. That obviously is some sort of slogan that's going around. Make Iran poor again is, an increase in Iranian sanctions and really trying to remove them from, the supply chain and do it in a way that, China really can't take advantage of cheap barrels, I guess, or if they're going to take advantage of cheap barrels, then we're going to tariff China. Bassett had some very hawkish things to say about China as well. So I don't know. It seems to me like the direction of travel is more hawkish early and kind of, maybe deal with some of the fallout of this in the economy and in the markets and in negotiations than kind of go easy and just let inflation keep festering. The Fed's never going to be able to lower rates again. Popularity will decline. And then the odds of, keeping the House in 2026 and go down. And then he kind of stymies all the policy objectives that he had.
Craig, one other lever he might have is if he puts sanctions on Iranian crude oil, if he puts sanctions on Canadian imports, maybe he can offset that by strong-arming OPEC into more quickly putting some of these spare barrels back into the market to offset that. That's the one thing he could be thinking about. If I really want to be hard, as you talked about, and really make Iran poor again, really sort of put some pain on Canada near term, let me call up OPEC and say, look, Saudi, go ahead and move forward, putting those barrels back in the market sooner and quicker.
Yeah, I think that's on the agenda. And the question is, there was some discussion about that, and it doesn't seem like OPEC's ready to do it yet. So again, OPEC is, OPEC's biggest buyer of crude, is China now. So where does China fit into this, situation? And then you get into, the pricing of oil and the dollar and stuff. So there's a multifaceted, discussions being had here. I think, and we're going to learn a lot more in the course of the next couple of weeks and months. It's just, I think, surprising that we haven't learned a lot already. Right. I think that is different than the last time where the rumors and this stuff kind of led the markets to kind of feel things out a little bit more. This time around, he's been very tight-lipped. He hasn't been, doing a lot of tweeting. There was that story that came out about him going soft on trade a couple of weeks ago. And he immediately kind of came out and said, nope, that's fake news. Right. So it's, it's interesting. They're keeping a pretty tight lip. It seems like, way more professional this time around. And so, which creates that uncertainty. And so I think for investors, having hedges, thinking a little bit further out, right? I think the market's gotten very complacent about hedging during the Biden administration because you were able to hedge for the next day, right? Or the Fed meeting or the OPEC meeting or a data release, payrolls or CPI. Now you can't just hedge overnight with your portfolio. You kind of have to be thinking, I think, further out, 30-day, 60-day, 90-day hedges, which I think is going to keep, volatility and skew more bid than not during the first parts of this term than what we've seen over the last, 3 to 4 years. And I think that's a change in the investment landscape. And I think that'll be, interesting to monitor and trade accordingly.
The one thing I think that's a little nuanced about this is, back to America First, is when you think about C&Q, just as an example, because Bob's talking about it, and then you look at, like, let's say Devon Energy or some of the domestic E&Ps here in the U.S. that have ripped, and then you look at the RSP and some of the domestic companies, U.S.-based companies, outperforming the mega cap multinationals basically since the Kerry peak in July and really recently, and sounds like people are taking tariffs a little more seriously, is that maybe that is the way you have to think about it. It's maybe not just totally market risk off, but it could be like like days like yesterday where Apple's down 4%, and the big cap names where all the cap is are going to be sources of funds. And to Bob's point, how much of the Mag 7 does it take to lift these boats of the forgotten commodities, of small cap value, like some of these stocks that are just not been benefiting from the market structure or the regulation structure, like just how things are structured, right? And so if you think about risk reward, and you just listen to what Trump's saying, that maybe that's there's going to be a big rotation upon us. And I know that I sound like the boy that cried wolf, because everybody's been waiting for the rotation forever. But maybe we're a little early, in 2000, because there's a good analog of the late 90s present here, where the Fed cut prematurely and then they had to backtrack, and we had a lot of Asian and emerging market issues, as we do now. And what if happens is, when they finally get, because I think Trump actually wants a weaker dollar, but I think he wants it stronger in the beginning, and the tariffs and some of these things are ways to get it. If we get to the point where, okay, now the money's flowing out, well, international equities can do exactly what energy just did. Like, some of these things are completely on their own. So like when we just say global risk off or US risk off, I think it's a little more nuanced than that. I think it's really, we're talking about the bubble that is mega caps in many ways. Do you agree with that or disagree with that?
Yeah, look, I mean, I think, a couple points. One, just, a 4% move like we saw in Apple yesterday, right, is $140 billion of market cap swing, right? So yeah, I don't know the entirety, magnitude of the energy industry, right? But you think, a little bit going in there. I mean, that's why you get these outsized moves on a percentage basis in some of these smaller names. And so there's definitely opportunity there, with calls, and leverage to kind of, take advantage of some of those rotations. But I think, it's interesting, the Trump policies, or at least what he's talking about, seem to be Main Street over Wall Street, right? So we've been, America has benefited from a strong dollar, right? The capital flowing in has benefited the wealth effect in America, and has drove stock valuations and mega caps to these record levels. And so, to the extent that eventually we start to have more of a weak dollar policy to help bring manufacturing jobs back and focus on domestic production, if the capital then is flowing out of the U.S., what does that mean for our stock market? What does that mean for our assets? And so I think it's a very interesting, again, dilemma, right? If you policies are supporting a weak dollar, and that's going to take the equity market down, again, is Trump going to be happy with that, right? Is that given his scorecard? So,
well, I give you yesterday as an example, right? Like, I look at the board yesterday, and 7 of 10 sectors are up. 60% of stocks were up yesterday, but the market was down a little bit. And, because there was just a lot of money that came out of the top, like you said, Apple, Tesla's down. And, I also don't think it's going to be as easy. And I want to come to Bob on this about the weak dollar, because if we could rewind to the GFC and the post GFC period, and I just don't think Americans in general appreciate that it really was oil and gas that brought us out of that. China levered up some, but the shale revolution changed the dynamics, and Bob, how much were we producing in oil pre-GFC versus where we are at right now? And then let's talk a little bit about LNG, because it seems like with all the trains coming online, that's going to be another big export. And I'm sure Trump's talking about, hey, you got to buy our LNG. Maybe talk to that a little bit.
So you're looking at oil production when versus today?
Like 2007, 2008, like that period when the dollar was extremely weak back then, is all I'm trying to say.
Yeah, no, I'd have to go back and look at the exact number, but we're producing.
I think it was like 6 or 7 though, right? Something along those lines.
Yeah, we're producing quite a bit more oil today than we were then. Quite a bit. I think we're 13.2 million barrels a day today, and back then I think we were closer to. I'd have to go back and look. It's probably 9-10 million barrels a day. I'd have to go back and look at the number. But I mean, these companies have been in the efficiencies that they've been realizing have been significant in ramping up that oil production. But you're right. You go back to someplace like Midland, Texas, it's boom and bust. When oil is where it is today, they're employing a lot of people. But back when oil dropped to $20 a barrel, everybody got laid off. But you're right. I mean, it's been a big boon to the economy. The number of people the oil and gas industry employs and the technology that they employ and everything that goes with that is huge. I mean, the amount of steel they put in the ground, the oil and gas industry has been a big boon over the past 10 years to the U.S. economy.
Yeah, and what about LNG? Because we're talking about trade, we're talking about tariffs, and natural gas is like we have seas of natural gas, and now
Yeah.
we have in the next 18 months 12 BCF, I believe, of export capacity coming online. So, I'm sure in these conversations they're talking like, hey, we got some LNG to sell you, and that's dollar positive to me. I mean, what's kind of your view on will that all get filled and is that the case that Bernstein's making for this new era of nat gas, $4 or $5? I mean, do you see a bullish outlook for that? And that has to be positive for the USA.
Yes, it's positive in the sense you will have this big increase in LNG exports. But the gas always seems to come on. I mean, there's a lot of gas that come on. Is it $3.50 to $4? Yeah, that's probably the right range if we're going to increase U.S. natural gas production by 10, 20% over the next decade just on LNG exports and AI data center demand. But, the price, it never ricochets to $5, $6 because all of a sudden it's easy to turn on the taps for a lot of this natural gas production. But the LNG is going to be positive dollar-wise, yeah, because we're going to be selling natural gas as LNG to Europe and other places, particularly probably to Europe, depending on what happens with Russia and their pipeline and exports and such, but definitely going to see a lot of LNG export capacity come on. The thing to keep in mind too, though, is, and this was brought out at the Goldman conference a little over a week ago, that when we get to 26 and 27, there are other people that are going to be bringing on LNG export capacity around the world, Qatar in particular. So part of the debate or the concern by some of the presenters at the Goldman conference is, well, come 26, 27, are we going to need all this export capacity from the U.S. that's coming online? So yes, you're going to see that initial uptick in demand as these export facilities come online over the next 2 to 3 years or, 2 years. But then beyond that, how much competition are you going to get from that globally? And so do you then sort of cap or plateau that demand from the U.S. as LNG exports and therefore kind of hit the ceiling on the gas price at that point? We'll see what happens there. But certainly in the near term, the next couple of years, it's going to be a big positive for the dollar in the sense of how much LNG we're going to be selling in dollars around the world.
Yeah, and I
isn't there a
go ahead, Craig.
No, I was just going to say, Bob, isn't there there's a massive LNG IPO this week? Is it? I think next week.
That's exactly what I was going to say.
All right, cool. Yeah, I was just thinking about that. But go ahead. Yeah, it was just $110 billion valuation, $2 billion raise or something. So it's probably going to add some light to the sector, right? People are going to have to be forced to do a little bit more work, kind of focus a little bit on it. There hasn't been a lot of ways to play this theme, so that'll be interesting.
Yeah, and Cheniere LNG's, that stock's been on a tear too, probably partly on that evaluation or anticipation of this deal.
Yeah, for sure.
Yeah, I mean, look, my favorite stock for the last 4 years has been Energy Transfer, and it's just up and to the right. It pays you. Now the distribution yield isn't as high as it used to be because it's been working well. But and Bob likes Williams, and LNG Cheniere has been an animal. I mean, ultimately, these are the stocks you want to own. If you think about what we're saying, these guys are benefiting from Trump. These guys are benefiting from natural gas. These guys aren't worried about all this. This policy is positive for them, and more importantly, this is infrastructure that's very hard to replace and to build like competition. Right? This is a key infrastructure that's fee business. It's not. Am I frozen here? You guys hear me?
Yeah, I can hear you now. You're
yeah, now you're good. You live. Yeah.
Okay. Sorry, I froze. But it's this key infrastructure that's U.S. based, that's got the positive demand functions from, like Bob just said, AI and now LNG coming online. Hard to replace, good yields, some growth story. I mean, when I look at that, and it's fee based, not so much like an E&P that swings around with the prices as much. These are just these. If you take anything away from that, just take an eye. And Bob, what's your favorite? Is Williams still your favorite of the pipelines?
I mean, yeah, that's the one I own. I like Energy Transfer. I just picked Williams as an easy C corp, but yeah, I like all those. And the other one that's really ripped here is Chart Industries. And I should have been on top of that. I sort of missed it. As soon as Trump was elected, that thing just ripped because they build all the components and the parts for these LNG export facilities. And so that's one that's been a huge beneficiary too.
Yeah, our colleague Robert Marson was long that and pitched this on Wall Street Beats in the Q4, and that used to be a really hot stock. Craig, I guess when we look out, as we kind of wrap up the show, what do you think is an interesting play here as we go into this new period? I mean, do you see things? You're talking about fading stocks. Is there anything else you think's interesting that you're doing or like mention?
Yeah, look, I mean, I think we are ultimately in the belief that Trump wants to be more of a weak dollar president, and so that's where we're gonna, we'll wind up. And so we are a believer in this transition as well, the rotation from big tech into commodities, it's industrials, into materials and energy, over the course of the year. I think right now, with the uncertainty around the tariffs and with China, I think it behooves us to be a little bit more cautious. And so we're not kind of plowing into everything, to start even though the moves have been strong, right? You mentioned these rotations that have already happened. I don't think we've missed anything, I guess is my point. I think it's hard to see some of the bottoms on some of these relative value charts, energy versus Qs, or, gold miners are a place where we're constructive as well. So I think that's where we want to be, rotating capital and away from, tech and big tech. But look, we're not, I think there's a lot of people who are looking for this kind of big cap to small cap rotation into IWMs. That's not an area that I'm really too constructive on. I don't really think people are going to be focusing on small caps, particularly. I think people are going to be looking for good, high quality names that are big and liquid, that are thematic in, and benefit from the Trump agenda, right? So it's kind of more in the larger cap energy, larger cap materials. Look, if you could find a diamond in the rough here, great small cap name, but I don't think small caps as an asset class is a place that's going to attract, much capital, because I don't really expect long-term interest rates in the US or globally to fall materially, right? I don't really think that the 10-year is going back to 3%, right? I think we're cresting in a new higher range. Inflation is going to be stickier for longer, a more of a deglobalized world with multiple supply chains, maybe an East versus West type of construct is going to, as the US is rebuilding and then our allies are building out supply chains, it's going to be inflationary. So I don't really, and plus we haven't even talked about, the kind of US deficit situation. And so, and all the issuance that needs to come and the terming out of the debt. So I think tactically you could be long bonds at times when they get oversold, but I don't think we're moving, 10-year back from, 4.8 to 5 to back down to 3.8 to 4. So I would be more of a seller on rallies of fixed income, which means I think that small caps are not where you want to be. But I think the rotation for us into old economy for the course of this year, maybe, particularly after this little growth slowdown that I would anticipate happens in the next couple of months, I think that's when you want to start start to see that evidence of that. The Fed's going to react to it. Trump's going to react to it. And that's when I think you want to be stepping in on that sell-off, is when we'd look to be really kind of plowing into some of these industrial material and energy type names.
Yeah, I think that's a great point. And I think that we've flushed that out a little bit in this call, is that the names that are in the right spaces that maybe were not thought of are going to get some money. We're talking about some energy stuff, some material stuff, but it's not like, small caps. Because if you look at the IWM, there's so many crappy biotechs and crappy companies in there that it's like, do you really want to own crappy companies? People want to own companies where the fundamentals are improving. That's, mostly how people invest. Are fundamentals getting worse or are they improving? And at least that they're stable, they better be cheap, right? And so I think that if money's going to move, and there is a lot of money, so I think that if you do your work and you find the areas you like, or just a couple stocks you like that can benefit from probably one of the biggest policy shifts or potential policy shifts, we'll see. I don't want to give them full credit, in a long time. And so, do some homework over this weekend and, just be ready for it. So let me just finish with Craig. Why don't you let the listeners know where they can find you and what you and Larry are doing over the bear traps?
Yeah. So I joined up with Larry at the Bear Traps Report. I'm a macro strategist, and we, provide, institutional type research, but we're increasingly democratizing that and trying to bring a lens on the buy side conversation to the retail community. And so we have a couple of new products that we're launching to kind of help retail investors kind of get a better understanding of what the pros are thinking, for lack of a better word. And so we provide some research and some chat capabilities and some commentary throughout the trading day. So at thebeartrapsreport.com or on Twitter, where I'm pretty active, CES921.
Yeah, and just for full disclosure, I'm a client of Larry and now apparently Craig's as well. So it's good guys. Thank you, Bob. I really appreciated that C&Q note. That was an actually really interesting micro way of looking at this larger macro topic. And I'm sorry that your long energy stock isn't ripping with energy with you, but I'm sure you'll do fine. I think that's it for us today. We appreciate Craig coming on. As always, Bob,
Anytime.
and I'm Ben Bry. Take it easy, guys.
Thanks.
Thank you.
All right. Thanks, Craig.
Thanks,
Good
Craig.
stuff. Anytime, guys. No problem.
Yeah, that was